it's the euro and the dollar that are sanctioning Russia, and yet 85% of the world is still trading with Russia. And I think both currencies, whether it be the pound, the euro, or the dollar, all three currencies are involved in these sanctions. And if I were the rest of the world, I would be leery to trust any of the three, in the respect that, we're the ones sanctioning them. We're the ones that they view as being hypocritical. And I think that the sanctioning of countries like Russia has had unintended consequences. So the rest of the world is coalescing against this type of behavior. So just to add to that point, I do agree with you very much. As far as silver is concerned, what's happening right now on the exchanges is really kind of crazy. We've seen somewhere in the neighborhood of over 1,400 tons that have been taken off of the COMEX market in terms of silver. Silver is just disappearing off the COMEX in a rapid fashion. The open interest right now is 1,500% greater than the registered category. So you have a massive rehypothecation in what silver stocks are available to be delivered on the COMEX. We're seeing metal being bled off the London Metals Exchange at a record pace, so much so that it's the lowest amount of silver in the LBMA vault since they started recording amounts of silver in the vault. There's less than, I believe, 10,000 tons of silver in the LBMA vaults that do not belong to the ETFs. Maybe even more startling than that is the long position on COMEX by the commercial banks, something I've never seen before. The commercial banks are net long right now in silver, and they've hoodwinked the managed money into going net short. So when you see the massive drawdowns on the LBMA, the massive drawdowns on the COMEX, where you're seeing in terms of gold drawdowns, look, a few weeks ago, 41% of all the gold kilo bars were drawn off the COMEX in one day. About 175 million ounces were pulled off the COMEX. And so, you're looking at a situation where the biggest money in the world is draining the COMEX, is draining the LBMA. We've seen 100 million ounces backdoored in the last 4 months out of SLV by the authorized participants. And for the very first time I can remember, last I looked a few days ago, the commercial banks were long about 5,100 COMEX contracts over 25 million ounces. So from the top down, not only is metal being drained from the COMEXs, but you're seeing the most sophisticated investors in the world go net long in silver, which is something I haven't ever seen before. I think it portrays for much higher prices moving ahead, and probably tougher availability as the bars are being taken off of the exchange. Those bars are what actually makes the blanks that make the sovereign coins, which are getting harder to get too, especially since the Queen died, all of a sudden getting even harder to get. And so, anything that has her likeness on it, the Maple Leaf, the Britannia, and the Kangaroo primarily, immediately went up in price. And when we sell out of current stock, getting them will be uneconomical, in my opinion. And as a result, everything else went up, the Krugerrand and the Philharmonic as an example, because everything else is getting hard to get. So let's buy those. Those go up too. This shows the micro fragility of the market. And when I mean micro, I have long felt that from a macro perspective, getting product will ultimately be very difficult in this industry, because Rick Rule talks about 0.5% allocation to precious metals across the entire financial matrix. So if that number changes to 2.5%, which coincidentally would only be the 40-year mean of the price or the allocation rather of metals to the U.S. portfolio, that's a five-fold increase in demand when this industry can hardly handle the demand that we have right now. It will make getting product next to impossible. And I have felt for a very long time there will be this moment where people are awoken. Now, I could argue that there's been a much greater participation and awakening, if you will, from the mainstream into this industry, but it still represents but the pimple on the elephant's ass. And that's the truth. The big money has no idea about silver and gold yet. maybe they're beginning to understand that there's something not right in the economy. But when they see their 401k collapse, when they see their equity portfolio collapse for whatever that reason may be that incites that or ignites that precipitous decline, they have to come out and notice precious metals. And when that moment happens, there's so much liquidity out there. There's so much money that's been created that it will just overwhelm this industry. But when we look at an event like the Queen dying, my perception of this shortage in supply is a macro perspective that comes when this big event happens and there's awakening. But when you see a micro perspective like the Queen dying, and like that, everything dries up, it should underscore the fragility of this industry. It is not an industry that is immune to the supply chain problems that we talked about at the beginning of this discussion. Here in the United States, we have to compete with everyone globally now who is experiencing inflation and understanding what's happening to currencies. It used to be, when everything was hunky-dory, that we would be filled. I would have distributors call me and say, hey, can I just stage 20,000 Britannias and 50,000 Krugerrands and 100,000 Philharmonics in your warehouse? You can keep them there. We won't charge you for them. If you need them, they're yours. If not, we'll pay to have them shipped out. That's what it used to be. Now I have to buy stuff 3 months in advance, hedge it, and run logistics to get into my office. And I'm competing with, the people in the UK from the UK Mint. I'm competing with people in Australia for the Kangaroos. I'm competing with people in Austria for the Philharmonics. It never was that way. And you see an event like the Queen dying and bang, everything just rises. I think this market ultimately is going to be defined by the inability to source product, because it just is not, it is not a market that is flush with product. And, I get a lot of heat for this, but I want to be very clear that, yeah, there's been decent product for the last 3 years, but I will tell you, it is the most difficult part of my job is securing, continually rotating product in and out. It's getting harder and harder and harder. And when that moment comes where people are obviously awoken to precious metals as an alternative, instead of the people that you and I talk to every day who have been enlightened and awoken to this beforehand, who take for granted how easy it is to get it, I think for the other people who come late, even 30 seconds late, it'll be a different story. So, yeah, it's an interesting time, and supply chain problems are certainly not immune to this industry. I think the real dent will be made by the commercial banks squeezing the managed money. That, to me, is where the real dent will be made. And if you look at what happened on the London Metals Exchange in March with the nickel failure, this was, I believe, the wake-up call to the commercial banks, because when the nickel market failed and the LME invalidated this trade for the first time in 140 years of their exchange, and I think it really put a damper on the credibility of the LME. I think it woke up the commercial banks, and I think they're trying to get their house in order by incentivizing the managed money through cramming the price down in the beginning of March. The commercials did. And I think the managed money just said, I've had it. We're out. It's 40-year high inflation, war everywhere, a war in the Ukraine, trouble everywhere. The economy's a mess, and yet the price is getting smashed. We're out. So not only did they sell their longs, which the commercial banks gladly gobbled up, they went short. And they're massively short. And who went long? The commercial banks. If you take the producer merchant category out of the commercial category, just the banks themselves are really long. If you add the producers and into the commercial category, which they are, they're still long about 5,100 contracts, over 25 million ounces. I can't ever remember seeing that. So you have the most well-funded, well-informed, sophisticated investors on the planet going net long, I believe, setting a bear trap for the managed money, and it has allowed them, the managed money shorting the price so low has allowed the commercials to cover their shorts. They're doing the dirty work for the commercial banks. The real squeeze will happen on the exchanges. And, I think the real squeeze would happen when this new Moscow exchange that is being bantered about comes about, because all they would have to do, this new Moscow exchange, who, when they came out and talked about it, they said, look, we want to issue an exchange that will fight the manipulation of the West, of the LME and the COMEX. Look, they're not bitching for the last several years because they're the ones accumulating it. So they're using the West's own stupidity against them. The West is suppressing the price, and who's gobbling it all and having it all sent home? To East. This is classic misdirection. They're using the leverage of the West stupidity against us, and by accumulating all the commodities. But once they have everything in hand, then they'll want to set a real benchmark price. Well, that's the new Moscow exchange they're talking about. How would they blow everything up? How can they squeeze everything? Peg silver to $50 day one. That's your AM fix. Put gold at 3,000 day one. That's your AM fix. In Moscow, bang, everything will arbitrage straight over to the Moscow exchange, and it'll blow up the Western exchanges. So I think it's the silver squeeze certainly has awoken some people. Certainly it's made it tougher to get product, physical product. But I think the real price, unfortunately, is still set by the banks and by the COMEX market. The paper market sets the price for the physical market. It is the ultimate tail wagging the dog. But I think that'll change. And we're seeing steps that are moving in that direction, whether it be the commercial banks going long and covering their shorts, whether it be the bleed down of massive stockpiles of metal off of all of the world exchanges, including the Shanghai Gold Exchange, including the ETFs, and or now the talk of a real exchange trying to set a real price. And these are the kind of things that will happen, I think, without any warning at all. Now, we see the warning. We can see the breadcrumbs. The question is, do you trust your gut and your intuition enough to take that plunge and to accumulate when, prices haven't accentuated yet? Because by the time they really start to take off, I think you're too late. You have to get in when the prices are low, because you can see the big players are using price to misdirect. And if price were such a determinant, then why is the biggest money in the world draining the exchanges of metal? Why are they going long? Why are they taking possession? Why are they removing counterparty risk? It's because that's how you win. You win by buying low and selling high. You win by doing these maneuvers when everyone is blinded by the cover of putrid pricing. No one's looking over here as the positioning is happening by this most sophisticated money in the world. And once they're in, they'll let it run, just like the commercial banks are not net long. And if they do let it run, and if they don't short the rising price, it'll be something to behold. And you talk short squeeze, the managed money is so record short, the managed money doesn't have the pain threshold that the commercial banks do, nor the deep pocketbooks, and they have to answer to their investors. And as the price starts to rise and they start to feel that pain, they're going to sell, which only will incite more covering and higher and higher and higher prices. That is at least the theory. We'll see how it plays out in real time.